Right now, BigBear.ai, ticker BBAI, is trading live at $6.53 per share, and it is getting hammered, down a painful 8.92% on the day. The volume is already massive, with over 24 million shares changing hands just in the first hour or so of the New York session. Now, the immediate reaction for many, especially if you're just glancing at your Robinhood app or Fidelity mobile app, is pure panic. This stock just had a monster 20% spike a couple of days ago, and anyone who bought that rip is now deep in the red. The expectation was that BBAI was finally breaking out, that the AI hype was taking this stock to the moon. But the reality hitting the tape today is something else entirely. This isn't just a random dip. This is the market violently repricing the company's entire narrative after digging into the details that everyone else missed just 72 hours ago. What we are seeing is the euphoria from its recent earnings call completely evaporating, and the underlying truth of its financial position is creating a serious gravitational pull. Let's establish the common ground, the story everyone believed earlier this week. The expectation was simple. BigBear.ai, this fast-moving data analytics and AI company, was supposed to be the next big thing in the defense and intelligence space, a smaller, more nimble version of Palantir. It's a hot name, one that gets bundled in with NVIDIA stock in terms of pure AI-driven excitement, even though they are completely different businesses. On Monday, November 10th, the company released its third quarter 2025 results, and the headlines looked great. They beat on earnings per share, reporting a loss of only 3 cents versus the 5 cents analysts expected. They also beat on revenue, coming in at $33.1 million against a $31.8 million forecast. Alongside this, they announced a massive $250 million definitive agreement to acquire a generative AI platform called Ask Sage. The stock exploded. Analysts piled on. H.C. Wainwright reiterated their strong buy with an $8 target, and Cantor Fitzgerald raised its target to $7. For anyone doing their own self-investing, this looked like the perfect storm of positive catalysts. The expectation was that this stock was on a one-way ticket, leaving the $6 mark in the dust. Now let's talk about today's brutal reality. Why is it collapsing 9%? Because that entire narrative, that expectation, was built on a very thin veneer. The market has had time to read the full 10Q filing, to listen to the analysts' questions, and to do the actual math. And the math is not good. That revenue beat of $33.1 million, while it was better than the whispered number, it represents a 20% decline from the $41.5 million they did in the same quarter last year. Let me repeat that. Revenue is down 20% year over year. In a sector where companies like NVIDIA stock are posting triple-digit growth, a 20% contraction is a five-alarm fire. The company's excuse was lower volume on certain Army programs. This is the core risk of BBAI, a risk that a flashy acquisition can't hide. Their core business is not just flat, it's shrinking. It gets worse. The company's gross margin fell from 25.9% last year to 22.4%. And adjusted EBITDA, a key measure of profitability, swung from a positive $0.9 million in Q3 2024 to a negative $9.4 million this quarter. They are making less on what they sell, and their spending is increasing. That 20% stock spike on Monday wasn't fundamental buying, it was a classic brutal short squeeze. The stock has an incredibly high short interest, around 20%, and that good headline news was just enough to force a panic cover. Today, the shorts are back in control, and the fundamental reality is settling in. This brings us to the $250 million bet, the acquisition of Ask Sage. This is the real story, the pivot. The company's attempt to buy the growth that its core business is clearly lacking. The expectation is that this is a brilliant move. Ask Sage is a generative AI platform built for the secure, regulated environments that BBI lives in, defense, national security. It's projected to do about $25 million in annual recurring revenue in 2025, which would be a six-fold increase from 2024. As part of the deal, Ask Sage's founder and CEO, Nicholas Chayan, the former chief software officer for the U.S. Air Force, a very big name in that world, will join BBAI as its new chief technology officer. On paper, this is a fantastic story for investing sites to tell. They are bolting on a high-growth generative AI asset and acquiring a key industry leader. This is the bull case in a nutshell. They plan to cross-sell this new modern platform to their existing government client list and use it as the new face of the company. It's a compelling piece of online investment thesis. But what's the reality? The reality is the risk. BigBear.ai is paying $250 million, a mix of cash and stock, for a company with $25 million in projected revenue. That is a 10x forward sales multiple. They're paying this premium price at the exact same time their own revenue is shrinking by 20%. This is a high-stakes gamble. This isn't like buying a stable Fidelity ETF or a blue chip like Apple stock. This is a small-cap company leveraging its balance sheet to bet on a turnaround. Integration is notoriously difficult. Will Ask Sage's platform seamlessly merge with BBAI's legacy data analytics, or will it be a culture clash that burns cash? The market is looking at the shrinking core business and this very expensive new purchase and asking a simple question: are they fixing a leak, or are they just buying a fancier, more expensive boat while the first one sinks? Today's 9% drop suggests the market is deeply skeptical. This kind of volatility is a nightmare for a passive, intelligent portfolio. This is a pure active trader stock. And right now, the traders on Interactive Brokers are likely having a field day with the options premiums, while the buy and hold retail crowd on SoFi Invest is left holding the bag. So what does BigBear.ai actually do? It's important to understand this. They are not building the large language models. They are not making the chips. They are an AI-powered decision intelligence company. They take massive, messy data sets, primarily from the U.S. government, defense, and intelligence agencies, and provide analytics to help leaders make decisions. Think predictive logistics for the Army, supply chain management, or threat analytics. The idea was to be a one-stop shop for this, much like Palantir. But as the Q3 numbers show, they are heavily dependent on a few large contracts, and when one of those contracts, like that certain Army programs, dials back, their entire top line gets crushed. This acquisition of Ask Sage is a clear attempt to diversify and modernize to move from just data analytics to the much hotter generative AI space. But it's a pivot born from a position of weakness, not strength. Looking at the technical chart, the picture is just as messy. That 20% spike took the stock right up to resistance near $8, and it was violently rejected. Today's drop has smashed it back down, and it's now testing a critical support zone. Technical analysts are watching the $5.60 to $5.80 area. If it breaks below that, there isn't much holding it up, and a move back into the $4 range is absolutely on the table. The long-term 200-day moving average is still holding, so the long-term idea of the stock isn't dead, but the short-term and medium-term trends are now decisively broken to the downside. The volume is the only thing that's consistently bullish, but it's panic volume, not accumulation volume. This isn't the steady, managed inflow you'd see in Fidelity mutual funds. This is a knife fight in a phone booth. This is a stock at war with itself, the retail bulls and short squeeze artists versus the institutional short sellers and fundamental bears. This creates the ultimate conflict for the future. The expectation, the bull case, is this: the Ask Sage acquisition is a masterstroke. The new TCO, Nicholas Chayan, is a visionary who will integrate the tech flawlessly. They will start announcing new contracts that combine their old analytics with this new generative AI, and the revenue decline will reverse into explosive growth. The shorts will be forced to cover for good, and the stock will easily clear $8 and make a run for its 52-week high above $10. This is what the bulls who are buying this 9% dip today are betting on. This is the narrative that keeps the Robinhood traders hitting the buy button. The reality, the bear case, is far darker. The core business continues to rot. The Army programs never come back to their previous levels. The Ask Sage acquisition proves to be a cash-burning, high-multiple distraction. The $250 million outlay hamstrings their ability to invest elsewhere. Competition from Palantir and the new wave of AI startups eats their lunch. The stock breaks support at $5.60, and the long-term holders finally give up, sending the stock right back to where it was for most of last year. This is the reality that the 9% drop is signaling. This is the risk that sophisticated investment managers at places like Fidelity Wealth Management are warning their clients about. This isn't a stock for a retirement account. This is a speculation. So, to summarize what we're seeing, BigBear.ai is down 9% to $6.53. The initial expectation, fueled by a headline earnings beat and a major acquisition announcement, was that this stock was on a new bullish rampage